I wonder how long that's been on. So anyway, now we're looking at real estate. Real estate has not been a great sector for quite some time, and so we've been completely out of it. We do have what I would call an orphan position in Annaly, and let me quickly explain an orphan position. So um, what we've done in the past is, remember I talked about purchasing 100 shares to be able to sell calls and puts against it, right? Well, anytime that there's more than 100 shares, like sometimes I'll do 101 shares, 102, 110, something like that. Okay. When we then have to sell 100 shares, we have, one share left over. And so what I'll typically do is I'll leave that as what I call an orphan share. And so what that means is that we own just one share of that particular stock, which we don't do anything with. We just own it. Okay, it just sits there and does nothing. We continually make dividends on that one share, but we're not going to sell it. We're not going to do anything with it. Okay, so we do have an orphan share of Annaly, and actually that orphan share is 10 shares, which represents something like I think $90. So it's not a lot of money, but those shares just kind of sit there, and the biggest reason why um, we keep them is because Annaly has such a large dividend. So those 10 shares generate a dividend every 3 months. And so it works for us. But this is the first time in a long time that we've actually had to look at Annaly as a potential new position. Okay. UDR, Annaly, WPC, those are the positions that we're looking at. And what I want to do, so just because we've been out of real estate for so long, I wanted to quickly go over what these companies are and what they do. Okay, so Annaly is actually a mortgage lender. Okay, so they're in real estate, but not really. Okay, so they're more of a bank. Okay, but they lend specifically to persons wanting to purchase real estate. Okay, so again, we're talking about residential loans, we're talking about commercial loans. Okay, and the really cool thing about this uh, um, business profile, for lack of a better word, is that all they're doing is they're borrowing money at like let's say for example, let's just say 2%. We're not looking at the financials right now, but let's just say they're borrowing money at 2% and they turn around and loan it out at 4%. That's what they do, just that simple. Okay, and their profit is made in the spread between what they can get a loan at and what they can lend at. Now, over the last, I would say, couple years, those rates they haven't been uh, very far apart. What you're getting money at and what you're lending at is very close. I mean, right now we are in a buyer's market. Okay, because loan rates are so low, everyone is going out and getting these super low interest rate loans and then buying real estate. That's what's happening. Well, that's great for a company like Annaly, except for they're having a harder and harder time getting loans themselves at cheaper rates to compete with the lower rates that people are buying these loans. All right, so that's what's going on with Annaly. But great company though, been around for a while. Like I said, they pay a huge dividend, um, and that's what's great about them. But that's Annaly. Okay, so WPC. WPC is a real estate company, but they deal primarily in commercial real estate properties. Okay, so no residential, no houses, no apartments. Okay, strictly commercial. Now, with the COVID stuff happening, again, I haven't followed this company very closely, um, but um, there are lots of companies that aren't able to operate simply because of COVID. So they've been given loans, right? We all know about the COVID loans that go to pay your rent and lease, whatever. So that bodes well for a company like WPC. But that stuff may be going away. And We're kind of in the thick of this whole COVID thing. I think everyone kind of has an idea of kind of where things are going, but I don't know if we've really seen any real fallout. Okay, but that's WPC, straight up commercial properties. All right, and then we have UDR. Now, UDR is the company that is in the return portfolio. Okay, so that's where our software is pointing us to. Okay, and so UDR operates primarily in residential real estate. So we're talking about, you know, apartments. We're talking about community properties. Okay, and this is happening, I believe, primarily in Colorado. I could be wrong about that. I'm not sure exactly what areas they service, but I know they're headquartered in Colorado. All right, but either way, their deal is residential. Okay, now that does give me pause because residential, of course, is going to be, you can argue that residential is going to be a bit more risky than commercial. Okay. Now, there's another theory that says residential is not as risky because people are more worried about losing their homes more than they are losing their businesses. So there's something to be said for that, right? But at the end of the day, we are talking about, primarily residential properties versus commercial versus basically, like I said, a mortgage lender. All right. So let's take a look at what these companies are doing. Now, keep in mind that because they are primarily in different industries, even though they're in the same sector, their numbers are not going to really line up. Okay. I mean, commercial properties are vastly different than residential. And then, of course, we have Annaly over there that's just doing lending. So it's completely different, but we'll look at it anyway. So we see that the UDR has increased their revenue year on year, which looks really good, right? And we do see that their net income has dropped, just a bit. Okay, it's definitely dropped off, and this is not the first year drop. You see that from 18 to 19, we also had a drop. Okay, and this is again just looking at the last 3 years. We're not doing anything really in depth here, just looking on the surface. Okay, so that's where we're at there. Take a look now at Annaly. Annaly lost a bunch of money. 2019 lost a bunch of money in 2018, and they're currently negative this year as well. Net income again, a big negative. So that's not great. It's not losing money. And again, it has a lot to do with the rate spreads. Annaly makes a lot of money when they're able to get those great deals on loans and turn around and sell a loan to somebody at a higher interest rate. That's just not happening right now, and not going to happen in the near term either. Interest rates haven't budged, and I don't expect them to. In order for interest rates to move up, we'll need to have a big resurgence in our economy to make the Fed want to move interest rates. Now, there is some talk around what's going to happen after COVID. Okay, there's talk that after COVID things are going to open back up and people are going to just go crazy. Okay, in a situation like that, Annaly is probably where you want to be. Okay, now what does that mean for a return portfolio? Remember, the return portfolio is based on the last 3. Okay, the last 3 years. Over the last 3 years, Annaly has not done so well. So even when we do get to that period of everything opening back up, people going crazy, Annaly is probably not going to be in that return portfolio either. Annaly might make it into the alpha portfolio, right? Because when things are going great, Annaly is doing great. Okay, but again, that's something that we'll look at and talk about when we get there. Okay, but as of right now, Annaly is just, nothing looks good. Even visually, it's just a constant step down. Okay. All right. WPC. WPC looks like they've, lost a little bit of revenue, but they were able to eke out some decent gains. Okay, um, didn't do so well last year. I mean, I would call their situation rocky. That's exactly what this chart looks like. Looks like a big rock. Okay, revenue steadily increased, but when you get down here to net income, it's just not doing great. Okay, so just visually speaking, they are again kind of rocky, right? Not that bad. Annually, constant, just not great. And then WPC is, not great. I mean, real estate itself has just not been a lot of fun, which is why we've been out of it. Let's take a look. Annalie, just knocking everyone's socks off when it comes to returns over the last 12 months. A lot of that has to do with this one crazy month in May, right? Where, again, because this is like a bank, okay, the way investors look at this stock is once Annalise priced the book, once, I don't have it. I don't have it here. Once Annalise priced the book gets below one, right? People are just going to jump into this thing because they're like, look, there's no way that their stock price should ever be below their book value. Okay, so because their business is all cash, there's no real assets that they're holding on to. Their assets are literally those loans that people are paying back. And unless think that people are gonna just default on most of their loans, or banks are gonna default on their loans, then their assets are good, and so it's a great stock to trade, but not necessarily invest in. You were in Annalie before, and you didn't do so well in that position. Made a little bit on dividends, but the stock performance was not great. VTR is the next best player in that sector, and everyone else is just really ho hum. Barely zero. A lot like what you saw in the communication sector. Not doing so great. WPC, however, has been in 5 of the best performing portfolios over the last 12 months. And so I think there's something to say to that this portfolio was best out of everyone. And WPC just happened to be in those portfolios. Let's take a quick look at what that looks like, because I don't know if WPC was in just the same portfolio or is in a bunch of different ones. I don't know. But it's going to be in white here. The WPC there. WPC here. So this goes right back to the same portfolio that had Campbell Soup in it. Let's see if that holds true over the next couple. Okay, see, so this is a different portfolio. Campbell Soup is not in this one. It's in another portfolio that Campbell Soup is not in. So we're seeing WPC in 1, 2, 3 different portfolios, but they just happen to be the best performing portfolios. Okay, so I think there's something to say about that. I really do. Especially being that, like I said, we're looking at a sector itself that is just not performing very well. Real estate. This goes back to building materials, right? The basic materials and the building boom and bust and kind of where we are at in our economic cycle. Real estate is not It's not a hot market right now. Not for the big boys anyway. Let's take a look at some numbers here, some attributes. Put in there. All right, WPC. Let's throw in VTR just for fun. See what we get. All right. So right away, like I said, annually 10% dividend. Remember, we're getting a 10% dividend on those orphan shares of annually anyway. So, that's something. Compared to the other dividends, I mean, it's just, so WPC, my goodness, 6%. That's awesome compared to these others here. Let me see, PE, UDR, PE is way up there. Again, it's usually indicative of a company that people really believe in, that they're putting their money behind, which is really driving the stock price. It's also indicative of the stock price increasing while earnings are decreasing. Okay, the market may be wrong about this, right? It may be wrong about this. That's definitely something that we may need some further research in, is to find out where are those residential properties that they're owning and managing. Okay, maybe those are high income, high net worth properties that are performing really well compared to the commercial properties that WPC holds, right? Again, just want to go back to this ratio. WPC is at the 27 PE. It's possible that stock price hasn't moved very much, but earnings have increased as well, which brings down the PE. And that's the reason why these PE averages make a difference, right? So we're looking at a 5-year low of 18. Right now we're at 27. A 5-year low for UDR at 25, and we're currently at 85. So clearly, UDR is at a much higher, at the higher end of their PE ratio than WPC. Now, does that mean that WPC is going to perform worse? And again, we go back to the dividend. Like I said, a high dividend is indicative of stock price that is falling. Okay. Let's take a quick look at purchase price and current price. We see that UDR price has fallen. WPC price has fallen. VTR price has fallen. Annually price has fallen. I mean, that's across the board in the real estate sector. So, knowing that the price is falling, okay, if the PE is really high when prices are falling, that means earnings must be really high. There's just no other way that works. I mean, you're talking about a smaller number up top. That means that the earnings have to be, well, wait a minute, no. I just thought about that. If price is going down, we have 10 on top. We have earnings of 1, that gives me a 10, versus earnings of 2, that gives me a 5. So in reality, what's happening here is the larger PE means smaller earnings or a higher stock price. But we know that these stock prices are falling. So it's got to be that these earnings are falling along with it. Otherwise, how does it maintain such a high PE ratio? So in this case, I'm going to say that this higher PE ratio points to a poorer earnings, right? A poor performing company. Now, let's keep going here. Net profits could be better for WPC. I think we already saw that in my notes anyway. WPC has more cash on hand. We already talked about that, being a good and a bad thing. Check out the short interest, though. We see is much higher for UDR than WPC. I think that says something. And to be honest with you, I mean, if I was putting my money up on this, I would definitely bet on commercial real estate versus residential real estate. And I think that is being shown here in the short interest ratio. Okay, so alpha is going to be the same. I'm looking there. Up and down is the same. Beta is the same. Turn is the same. Volatility is the same. Score is roughly the same. UDR is worse. Management score, primarily due to the cash on hand. I want to go back to that. If I can. Yeah. So again, cash per share. It means that that stock price is backed up by more cash else, and that's not necessarily a bad thing. And sometimes it is. It just depends, right? Okay. So let's now take a look at the UDR and see, has UDR been on any well-performing portfolio? Don't see it here. Now the question is, has it been on any portfolio at all? Because sometimes companies don't make it to portfolios at all. So let's take a quick look and see if we can find UDR in any of these portfolios. Oh well, it's a term portfolio. Know that. Okay. So I'm going to assume too it's going to be in the standard deviation too. Which is no, it's not going to be in any of the dividend. Okay. WPC is in a lot of these things, and that's because of the dividend. And the reason why that's so important is because remember, I mean, at the end of the day, we are there's UDR. That's in beta return. That's nice. Like those beta portfolios. They performed really well. WPC is in that beta. WPC is in that beta. So it looks like it kind of goes back and forth. WPC is in that beta. And those beta portfolios perform really well. Last year and a half, WPC again. WPC is just like it's everywhere. It's checking off all the boxes for everything. Okay, there we go. Return, standard deviation, UDR. So, I mean, just, without going through all of these, it really looks like WPC is, yeah, look at this. I mean, it's checking off all these boxes for all these portfolios. And then I think because it's in so many portfolios, it's just happenstance that it shows up in some of the best performing portfolios. But I think there's something to say about that too. I mean, if it's showing up in all these portfolios, it's because it's the best of the best for that particular, scoring model. And sure enough, UDR pops up as well, but WPC shows up way more often. So that's good enough for me to really make a decision there with WPC. I do want to go in and really take a look at what those holdings are, though, just to make sure it's something that we can be comfortable with. Dividend. And so these are all the M scores, the management scores. I don't think we need to even look at these because we know that these portfolios don't do very well. So anyway, WPC is where we're going, contingent upon, like I said, being comfortable with those holdings and where they are. I'm going to look at both UDR and WPC.